Afternoon, ladies and gentlemen. My name is Benjamin Bale, and I'm here with my colleagues, Isabel Crowther, Jake Don, and Daniel Neville. The company we're presenting today is Premier Investments. We have a long recommendation at $35.04 target price, which represents a 19% upsides versus stock close on the 31st of August at 12:38 p.m. So a quick overview of the company. Premier Investments is a locally owned, publicly traded multinational company. It is a diversified retail conglomerate with exposure to both clothing and household appliances. It was founded in 1987, employs approximately 11,000 people, and operates throughout Australia, New Zealand, Asia, Europe, and all regions are overseen through their head office in Melbourne, Victoria. It also has a market cap of around $4.5 billion. Premier Investments Limited owns and operates Just Group, a retail conglomerate. The Just Group brands include Just Jeans, JJ's, Jackie, Alexander, Portman's, Dotti, Smiggle, and Premier Investments also owns a 26.27% interest in Breville Group Limited. As a juxtaposition to Premier, another company in the retail space to use as a comparison is Kathmandu, known for their commitment to sustainability and being a dominant force in the outdoor retail space. As reflected in the diagrams presented, Kathmandu presents a lot of volatility. And with a debt to equity ratio much higher, there is some solvency concerns long term, especially if the RBA choose to raise rates. We are bullish on Premier seeing growth in the prospectus, and with low cost of goods sold, cost of debt, and recording record profitability, we do not see the inflation represented through CPI and PPI numbers being as large of a concern for Premier as it is for Kathmandu. Some quick financials. We have Kathmandu's 52-week high at $1.68 and the 52-week low at $1.21. Their market correlation or beta is 1.82. Premier Investments has a 52-week high. That is $32.62 and a 52-week low of $20.84 with a market correlation or beta of 1.26. Now let's proceed on to the base case. So we've done some sensitivity testing and our base case has reflected rising prices. We've also put in the RBA's continued quantitative easing and other expansionary policies. We've also factored in PPI numbers for the next 2 years in which Premier have hedged against. So Premier have come out and said they're hedging against rising cost of production, but we have still factored in around a couple of percent cost of production increase, which will ultimately affect profits. With expansionary monetary policy, we predict a larger amount of money in the money supply and thus increased consumption in the retail segment. We have predicted a 9% growth rate with an 8% discount rate, a growth rate of 9% on 2020 numbers. That's really important to note. This is off the 2020 numbers, and a discount rate at around the rate of inflation plus the cash rate of 9%. So that's how we've got to that number. We note Kathmandu have a growth rate of 4.5% on financial year 2020 after a tough 2021, but have provided a higher discount rate as discretionary measure as they have much higher cost of debt, much more debt, and foresee the company potentially requiring further borrowing or financing to supplement their lack of consumer base as the pandemic continues to wreak havoc on travel and recreational activities in which they predominantly are experienced in. So we'll go on to our worst case. Our worst case reflects the market's response to a COVID relapse. We have factored in tighter government COVID mandates, tighter monetary policy, so raising cash rate and ultimately interest rates, which for Kathmandu is going to affect their already expensive cost of debt. So we have also put in worse than expected cost of production and CPI numbers. So they were already bleak, and that was already a factor we introduced, but now we have made it a little bit larger just to note that the downside risks are there. It's also worth noting that in our worst case, we have Kathmandu affected by mandates on travel and leisure. I'll just quickly go through. For Premier Investments, we have a growth rate of 1% and a discount rate of 10%, reflecting the COVID resurgence, potential leadership troubles with the new CEO, and any PPI or CPI numbers negatively affecting the cost of goods sold and ultimately affecting the amount that consumers have disposable income to spend on discretionary items in which Premier provide. Kathmandu, we have a growth rate of 1% and discount rate of 19%. We really see that there's a lot of downside risk with the Kathmandu investment, and that is ultimately reflected here. Now we're going to go into our best case. So for our best case, we have a growth rate of around 11.8% and a discount rate of 11% for Premier. For Kathmandu, we have a growth rate of 6.1% and a discount rate of 11%. Both scenarios here represent attractive economic conditions, attractive investment opportunities, really. Our best case sees the bull continue to charge for Premier with further growth on 2021 numbers and a record profit. We have the growth rate, as previously mentioned, close to 12% and a discount at around 11%. That higher discount rate is reflected by more stimulus checks driving consumption and an expansion into the online shopping market. We also note in this case that we see strong leadership by Richard Murray and a successful transition into the appliance market through their investment in Breville. We see further growth in the future for Kathmandu, but we can't see change in market conditions helping their solvency profile. And thus a 6.1% growth rate we see as the best case scenario on the horizon. And given their focus on the leisure sector as a discretionary spending item, we see Kathmandu not really hitting the point where Premier have clothing and stuff that people would be wearing to work or to leisurely activities rather than just outdoor activities or just surfing. The next we're going on to summary and risks. So as a risk, we do see in the next 1 to 2 years, depending on rates, if rates are risen, we do see the risk of a recession. We cannot really see real economic conditions improving over the next 1 to 2 years and do foresee a high chance of there being a recession. Monetary policy currently in Australia is very loose, and we cannot foresee a future where the government can contract without a recession. With this, we see a 20% price increase in our best case, as you would see in the green. But then our sensitivity testing also concluded that we also can see in the worst case around a 16% loss. However, we foresee this 16% loss holding stronger than the dollar and ultimately bouncing back after rates have tightened and the economy has reached full equilibrium. And thus we recommend a buy across all scenarios. However, it is worth noting that these economic environments affect the valuation of the cash flows. In an inflationary environment, the value of the company will likely outperform the depreciation in the dollar. However, if rates rise, the real value of the company will remain consistent with the dollar, but the cash flows may reduce along with discretionary spending as people have less money to spend on discretionary items. So our worst case is in the negative. However, the real value of the dollar would, in theory, be much stronger under these economic conditions, and then thus the potential 16% loss would be mitigated by stronger purchasing power of consumers and thus lower costs of goods. Our worst case scenario has a buffer window of around 13 to 20% loss, and that brings our lowest price down to around $22.06. But like we said, there's much of room to bounce back. So we have 3 follow-up summary and recommendations. 1, we recommend longing Premier Investments. We are long Premier Investments. We foresee the market over the next 2 years fostering that discretionary spending and enabling record profits in retail. And we can see the share price rise as much as 38% in an inflationary environment. We are planning on implementing under 2, so we can implement a hedge against key risks fairly easily. So we are planning on implementing the use of gold and silver mining stocks and physical possession of gold as our hedge against inflation, and therefore holding value if economic conditions do deteriorate further. So Premier is our preferred investment out of the 2. Thank you for listening.